I'm Bill Woodruff, founder, chief investment officer at WealthFactor. Today, I came across a investment proposal put together by a Morgan Stanley advisor, and it reminded me why I started WealthFactor. And I thought I'd go through and share with you some of the things that takeaways from this piece. As you can see, I have blacked out the names to protect the innocent. So let's dive right in. Right away, they're building themselves up, leveraging our vast resources. We're big, we can do a lot. I'm not going to dwell on any one particular point, but kind of build towards a variety of things here. They're recommending their select UMA, and UMA is Unified Managed Account. And what that allows for is the inclusion in one account of a variety of different types of investment delivery vehicles, mutual funds, ETFs, individual securities, outside managers who might employ their investment strategy using individual securities directly in a client account. It's a technology-based solution. One, I guess, if you want to call it advantage that Morgan Stanley has and being big, is they have this unified managed account and this technology that allows them to wrap lots of different things together. And so the statement here is the ever increasing complexity of investment management. And I would push back against that really, really hard. Investment management hasn't gotten more complex. What has gotten more complex is Morgan Stanley's need to justify fees that just absolutely don't make sense. Investment profile, this is pretty generic stuff. Here's what we recommend, and this is specific to the client or prospective client that their information is being blocked out. Equities and fixed income. It's interesting here, which is consistent with the risk tolerance being recommended. But what's interesting here is fixed income is put on here as a 20% allocation, and then you go to the very next page, and that entire fixed income allocation is represented by one high yield municipal bond mutual fund. And I'm going to spend a little bit more time with that in just a little bit. So, what we have here effectively from a Morgan Stanley recommendation using this vast need for doing very complex things in global financial markets and investing is 3 different managers, 2 of which are through separate account, and 1 that's through a mutual fund. Which, if you follow my comments, I am as big of a critic on mutual funds as there really can be. And then the 2 different equity portfolios, one is benchmarked against the S&P 500. So I'll come back to some of these points. But what really is a fairly simple exposure set. There's nothing esoteric. There's nothing complex about this, as perhaps they try to build themselves up. They spend some time kind of talking about their, what they do with selecting managers, and then watching them, how they do lists. I grew up in the investment management side of this business, and I thought of Morgan Stanley as a prospect for my investment strategy. They had effectively a pay-to-play environment. It really, in order to be available at Morgan Stanley, it costs $250,000 per year for the investment manager. So, Morgan Stanley builds this, in these couple pages here, this perception that they are canvassing the world for investment opportunity, and they have this robust process. My experience coming at it from an investment manager with a investment solution was, well, our first and most important thing is how much are we going to get paid for selling your product? So I'll try to keep my bias against the cultures of these large brokerage and banks to as professional as I can. And so here's this mutual fund that's being recommended. It calls out 0.62%. So since I'll just go in their order. So the expense ratio, or the net expenses for this fund, and this is before paying Morgan Stanley to recommend to you to invest in this fund, are 0.62%. And so I've got this tab here, this Morningstar analysis of this fund. And so what does this recommendation even look like? Well, this is a 5-star fund for Morningstar. I'll save my thoughts on Morningstar star ratings for another piece. But let's drill down into this a little bit. So on the surface, as you look at, let's see here. Oops, I pushed on the wrong one. Performance. You can see that this fund has done well against its benchmark, its category. So okay, that sounds good, right? And you know, that's a simple thing. You know, from a manager research and due diligence perspective, which again is part of my background, to me, I'm not going to buy a mutual fund or a manager or investment based on this. I'm going to dig a level deeper. And so let's take a look here. The portfolio is, I think, telling. So first of all, just for context, this fund invests in municipal securities that are effectively rated below investment grade. So these are the types of municipal bonds that have the greatest or highest probability of default in general, and that's what the benchmark is. And so in this section right over here, it shares the existing portfolio relative to its benchmark or category. So effective duration, or this is the portfolio's sensitivity to interest rates. So this portfolio is taking more interest rate risk than the benchmark or category. And you can see that as well in terms of its effective maturity, 21 years of maturity on average versus 15 for the benchmark. You can also see the so average credit rating actually in this broad measure is both BBB. But if you drill down into the breakdown, you can actually see where the fund in non-investment grade relative to the category has significant additional exposure, 14% in BB versus under 10 in the category. So on the surface, you say, oh, a 5-star rated fund, it's outperformed. Well, it's outperformed, but it's taken a greater amount of risk. And so let me tie this into the risk smart philosophy, high fees. And so there's lots of data here, but there's, if we go back to Morningstar's overview, it highlights that this fund is a high fee fund. Let's see right here, fee level high. So at this mutual fund level, you know, layers for my risk smart philosophy, having layers is inefficient. So the fee level is high on the from a mutual fund at this specific mutual fund level. And then you can see in the actual portfolio that that's really putting that fund in a position where it's forced to take more risk in order to justify its fee, and it has outperformed on a backward-looking basis the category during a period where really every investor has been compensated for pretty much any risk that they take. And so I wouldn't touch this fund with a single investment dollar. And so let me add to why that might be. So, you know, you can look at the portfolio, let's see here, performance. So, you know, it's common. This is what Morningstar effectively does in assigning its 5-star rating. Let's look backwards and say, well, how is this fund done? I believe the annualized returns are like 5 or 6%. And so, you know, investor looks at that and says, oh, man, it's generated 5 or 6. I mean, I'm in a municipal bond fund that's generated 5 or 6%. Well, what it's done in the past really has no bearing on what this fund will do in the future. And that's true really across all types of investments, but it's simpler in fixed income or bonds. So a bond fund or a single bond is going to appreciate or depreciate as market interest rates go up or down. And then there's going to be a yield component. And so as you can see here, the yield, which is at this point with interest rates already very low, and generally credit spreads very tight, the prospect of the market yields falling significantly further from here and then causing prices to appreciate is low. The yield for the fund is 2.86%. So the idea that, it's generated a 5 or 6% return net of fees backward looking, that's really irrelevant. And so really what you have here is an incredibly risky portfolio of municipal securities that has a 2.8% yield before Morgan Stanley charges you their fee. So let's go back to the overall presentation or proposal for this prospective client here. So performance review, everything here is backward looking. It's interesting here that it takes a little bit of digging. It's on a separate page, but you can actually identify that all of their proposals are gross of fees, and then their proposal benchmark is not all that transparent. Probably ought to be the S&P 500, given how much equity and then the likely correlation of the high yield municipals to equities. But you can see here, the proposals aren't all that different in terms of their long-term performance from the benchmark. And so it's, why am I hiring Morgan Stanley? They have this incredible reach and opportunity, and then they don't really, they spend a lot of time on the front end, and then it's kind of market returns, and that I see that pretty consistently across what I call the mass advisor. So here's a little bit more of the same, but they're putting the specific managers on here, and you can see that their particular manager has from a 3-year, 5-year, and 7-year. It looks like maybe 7-year they outperform, but it's kind of a mixed bag of, basically this is the S&P 500, and you should expect that really across any fund that is being managed relative to a large cap index. So we've hired, Morgan Stanley is pitching this person to hire them to pick something that really has limited potential to outperform or even perform without Morgan Stanley's fees to the equivalent of the S&P 500. So here's what we do. This is fairly generic, although should they have had 5 or 10 different separate accounts and all in there, there's certainly some overlay management services that's really impressive technology to deal with all of that mess. Again, to tie that though back to the last page, they're kind of creating that complexity in those layers in order to justify themselves, and that complexity and those layers probably don't do anything relative to the adding value versus just owning the index. So this is the part that inspired this whole piece, is the summary of their fee schedule, or the fee schedule here. I didn't realize that it was as bad as it is, but all the way out to $1 million, they're charging well in excess of 1.2%. And this isn't like once you get to $1 million or $2 million, your fees go down to 1.1. These are, as you can see, as you can infer on the right side of this, these are tiered fees. So at $5 million and over, you're starting to get down to 1%, but you're still paying 1% or more, effectively more at a portfolio of $5 million. And that's just the Morgan Stanley part. So you can see here with this relatively small proposed $250,000 portfolio, the aggregate or the combined advisory fee is 1.52 to Morgan Stanley. Then they have, this is nice in that they're identifying the sub managers, which are those 2 separate accounts that they're recommending through their UMA platform, Unified Managed Account, have 25 basis points that they cost. And then they have an overlay manager fee. And so I suspect this is the UMA fee, I guess, to deal with all their complexity. And so and then it's worth pointing out here that this is separate from the embedded 0.62, I think it was, percentage or expense ratio for that mutual fund. for a total effective rate of 1.82. And so let's think about this from the end investor's perspective. They're recommending a 2.8% yielding municipal portfolio, and the total fees for the 250,000 are 1.8%. And so that investor has the potential after fees, assuming we don't see, no high yield defaults, and interest rates continue to fall. Maybe we see some, again, that's a very limited potential for appreciation in high yield markets, given the current timing. But really, net of that fee, about a 1% potential return. I mean, that's an absolutely incredible amount of risk to take, and for so little potential compensation. It really makes no sense. And so the basis for this is, you have to draw some sort of conclusion that the advisors at Morgan Stanley just simply have a degree of incompetence. I hate to say that out loud. It makes me feel bad, but if they're looking at the backward-looking returns for this mutual fund, it's on the Morgan Stanley approved list because Invesco pays $250,000 and probably more, based on the incredible amounts they probably have through Morgan Stanley to Morgan Stanley, for the Morgan Stanley brokers to then recommend it. The Morgan Stanley brokers are saying, "Oh, it did 5% over the last 5 or 7 years. I'm going to recommend this to my client." Well, practically it makes no sense to own this. So I see this a lot. Most advisors, most independent registered investment advisors have business structures that have fees that are far less egregious, starting between 0.85 and typically not too much more than 1%, and so that's better. I would look at that and say, it's still probably a, again, for lack of a kinder way to say it, it's still probably a ripoff when the net investment deliverable is likely simply just following some sort of benchmark. So this piece is about 22 pages, and then at the end it's got 2 pages of kind of definitions, which is helpful. And then it's worth kind of noting that there is 1, 2, 3, 4, 5, 6 pages of disclosures. Part of that is linked to the potential things that they might recommend that aren't. But at the same time, the amount of complexity here is immense. And I don't know that many people that use Morgan Stanley, but clearly I looked up their financials from last quarter. I think they generated 4.5. Their wealth management business line generated 4.5 billion in revenue. So clearly they have lots of clients and lots of people use services like this. But honestly, if you have a portfolio from a Morgan Stanley broker, I'd be more than happy to take a look at that and share some thoughts. But really, regardless at their fee structure, they're faced with incredibly difficult decisions in trying to build portfolios. Fees force risk-taking and lead to inefficiency. And there's a bunch of compounding that has happened here in what I'm seeing from organizations like this. And I've chosen this Morgan Stanley piece because it was available to me. I would expect to see something substantially similar from most of the large national well-known brokerage firms, as well as the private banking world. Wells Fargo, UBS, Merrill Lynch. These sorts of business models are all the same. They are generally the same in concept, and the investors should get and can do significantly better. So that's it for my analysis of this Morgan Stanley piece. Hope you found it useful and hope you enjoy your day. Thanks.